Hello, everyone. My name is Ken Leon, Director of Equity Research at CFRA, and I'd like to welcome you to today's CFRA webinar on the U.S. and U.K. housing market. Now, before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. Today, we also have slides for today's presentation can be accessed through GoToWebinar panel under handouts, and we'll be referencing slides along the way. You may also submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. So CFRA is not only the largest independent research firm, but we are global. And today's program is only one example that underscores our global research capability. I'm really excited to have Varun Venkatraman on the call today. He's our senior research analyst from London, and he'll be covering the UK market, and we'll be posing the questions about whether we see favorable trends or not for 2020. Here's a quick agenda, kind of a rigid framework here on macroeconomic trends, the operating metrics, and we'll get to some company recommendations. First, an infomercial about who is CFRA. And our firm, as you look at this timeline, has a long history. It's a great franchise, great reputation in the market, first with CFRA in forensic accounting. And then in the October 2016, acquired the S&P Equity and Fund Research. So today, together, we're one of the largest independent research firms in the world. We also had the acquisition in 2019 of First Bridge Data, which gives us enormous ETF data and analytics capability. So the engine really for our research is coming from both of our disciplines of fundamental equity and forensic accounting, and regularly you're seeing our thought leadership in the publications of market commentary, whether it be Sam Stovall on equity strategy, Todd Rosenbluth on ETF and mutual fund research. What's behind them is enormous scale in terms of our coverage, 1,800 plus ETFs and mutual funds. And then the core industry company research is 1,500 global companies covered on a qualitative basis. And additionally, we share on our platform our model portfolios. And what's really exciting to me is the quality that comes out in our differentiated research, thematic research. It comes out every week, and it's essentially those 75 investment professionals, analysts, who curate data, able to see really what are the trends or relationships and distill those into investment views. To me, that's what it's all about with analysts on average who have 11 years of tenure. Finally, our independence. To underscore that CFRA does not manage money or make trades. We are an independent research provider, and some of our competitors don't have the independence as we do as it relates to we are investing everything just into fundamental research. Let's go to today's program. U.S. housing market. So here are some of the key drivers for housing and the real estate market. What's important is really on the economy, employment growth and income. We'll touch upon consumer confidence and why it spurs home purchasing. Importantly, look to the Federal Reserve on monetary policy, specifically rates, and how that plays down into the mortgage market. And we'll also cover in the presentation the impact in terms of how over periods of long time, of the last 15, 30 years, credit standards have changed. We're in a more conservative environment today, not only for the lender, but also for the borrower. And then what's behind a lot of the mortgage market is Fannie Mae and Freddie Mac that may, over the next few years, be privatized again. This is an important slide because this really frames our conversation today for the U.S. housing. Think that, when you look at presidential election, we would view that to be a positive. The rationale is to keep a healthy economy for the next 12 months. It's only 12 months to the presidential election next year, and that's going to be, we think, good for low mortgage rates. There's a lot to address on affordability. We'll cover some of the variables that go into that, but it's gotten political awareness a bit in Congress, but we've seen also in states like California and in New York rent control. Lumber costs, just on the profitability of U.S. home builders, have come down, and tariffs have gone away, but that's one factor. Skilled labor has really not come back since the Great Recession. Immigration laws have hurt skilled labor. So the pace, that's an important industry term, the pace of building homes, a little bit slower than you would like, but that's into a market with a housing shortage. And again, what doesn't help the housing supply is municipal county zoning restrictions. Land acquisitions are more challenging, especially in coastal markets versus building 50 miles outside of downtown Phoenix and Sunbelt markets. Moving on. So first metric is consumer confidence. It remains high. It was in September 93.2. It's been in the low 90s for some time, 95.5 in October. And the issue here really is even with trade tariffs and concerns about a slowing global economy, the consumer is healthy, whether it's been the impact on banks, the impact on lenders, the impact on housing. This has been a very positive story, but also we've seen some of the home builder stocks sell off in the 2 weeks, but it's been a concentrated bet in terms of investing. That may change. All right. Low rates spur U.S. housing, no question about it. If you go back, if we were sitting here a year ago and looking out November, December, we were looking at the 30-year fixed rate mortgage at 5%. So in my mind, covering the housing industry, this was the red light indicator. It wasn't green. And of course, clearly as you look back in history, and this chart goes back to 2001, lower rates have usually been the key driver. Most recently, though, we have seen the Trump administration and the Federal Reserve finally move to a low or a rate cut regime. And that's moved the 30-year fix down to 3.65. Today it's 3.73 because homes are more expensive. When you look at the fixed jumbo mortgages, they're at 4.12%. Very good environment as it relates to the rate issue. Let's take a look at what drives that is the Federal Reserve Bank. Federal funds rates are expected to remain low. That is important. We are possibly going to get another rate cut in December. I mentioned the term rate cut regime. That has started in June. We actually look back over 30 years in terms of rate cuts or rate rises. In a rate cut regime, it's generally good for the near or intermediate term. That will take us to the end of 2020, but ultimately it means that an economy is getting soft or might be weakened. It's only once in 1995 that we had one rate cut and then the economy and then rates bounced up again. So I would say it's important to watch that, and there's great sensitivity. Fact of the matter is, in the last week, we had two major sell-offs of home builder stocks. We saw the Fed funds rate move up from like 1.55 to 1.75 today. Okay, lower mortgage debt to household income. It's an important ratio. Essentially, this comes from the Federal Reserve, a snapshot of the U.S. household. What can I say here? The spirit of the day is more conservative. We're seeing household debt, particularly fixed or mortgage debt, at a low ratio compared to where it was before the Great Recession. And even though consumer spending is up this year, the fixed cost or mortgages or cost is down. And you may say, well, some of this might be because if you bought a home in 2003 to 2007, you might be underwater to your cost of what you paid. Prices only recently have gotten back to those levels. Another factor here is we just don't have the animal spirits because both the lender and the borrower is more conservative, and then some households just prefer not to own and just rent. So it changes the dynamics for housing. Affordability. These are the key variables, which is really here on slide 15. Mortgage rates, home sales prices, household income. So we would put an up indicator for mortgage rates. We already spoke about that. Home sales prices is a down indicator, and household income possibly neutral. Let's focus a little bit more on home sales prices. So there's no signs that home sales prices are flattening. This has partly to do with lower rates, but also supply and demand. So in some ways, it's a seller's market if you own a home. Another factor really relates to existing home supplies that we'll get to in more detail. And then also, sales prices of new homes have come up because land acquisition costs, 2/3 of your costs, are much higher today for the reasons I mentioned before. Nothing really to add on household income other than job growth is good, household income is good, but the housing costs on a line chart is much higher than household income. Slide 16, now we get into really understanding the housing market. It's not just one country market. You could say real estate is local. We kind of divide this into 3 regions or areas, if you will. The first is the West Coast markets. It was growing the most in the last 3 to 4 years. It has slowed down, partly because of pricing, not because of the economies, whether it's in the San Francisco, LA area, or Seattle. The home pricing to income ratio, which is affordability measure, is the highest in the country, still over 6.0. So we would be cautious on the West Coast. Builders, if anything, are trying to pivot to the demographic trend to millennials, but it's a tough market today. Mature markets means they're a big part of the existing housing market, but for new home buildings, off the record, it doesn't matter that much. The Northeast and Midwest, they're very seasonal. When you look at the rhythm of the numbers that come out from the U.S. Census on housing starts, residential sales, it's very small. And also on affordability, it's only in those metro markets, Boston, New York, where it's above the national average of 4.0 to 4.9. Washington, D.C. is another market that's come up, but what there is coming. So everything, all eyes on the home builder market, bottom line is the Sun Belt market. That's 65 to 70% of new residential construction. And we're also seeing 2 factors here. One has been affordable cost of living, job growth, low taxes, and then we'll get a little bit later into some political issues as well. Okay, let's get into some industry fundamentals and metrics. Moving to slide 18, home ownership. Wow, this is a powerful slide, and actually it would have been better if I took this back to 1980, because essentially we had socio-political policy going back to the Clinton administration and Congress, and then the Bush administration related to home ownership is a good thing. So it got as close as to 70%. It got really hyped up right before the financial crisis with subprime borrowing. That's essentially where you didn't even have to put money down. And we saw home ownership rates really jump. They have come down incredibly hard with bank regulation. Credit standards have tightened. We've also seen that it's been hard for the housing market to recover. It's really started in 2014-15. So there's been a bigger lag on housing recovery versus technically an economic recovery. And a part of this really gets to demographics. We have trillions of dollars in student loans. We have delayed household formation for millennials. And importantly, if you look at the Harvard University Joint Center of Housing, immigration is an important part for housing market growth, and I'd like to see that. Fannie Mae and Freddie Mac are kind of the shadows of themselves, but they're still a big player in the market. So on slide 19, supply of houses or shortages. I love this slide, and the reason I love it because it sums up the whole aspect of supply. We got as high with the subprime lending to total supply of 12 million available homes. Think about that. And then with the Great Recession, it has moved up as we talk later about housing starts. But in September, total supply was 5.38 million. That's a 55% decline from its peak. Then you look at that to the U.S. population growth. In 2000, it was 282 million. Today, it's 330 million. That's a 15% increase. So that gets to my factor about pricing on affordability. Let's move on. Existing home sales. Again, on the far left on commentary here, 90% of total home sales is existing homes. And then the first-time buyers are now 33%. That is moving up. That's a good thing. That's millennials. We're also seeing the all cash sales comes from two sources. One is traditionally the baby boomers who are empty nesters going into adult communities. But really in 2010 through 2013, it was smart money from private equity such as Blackstone buying thousands of homes in Arizona and elsewhere and then renting them. Let's look at those charts. Median prices, back to my point, remember on the regions, the West Coast and particularly California, average selling prices are almost 2/3 higher than the average, and they're not going down. And then, of course, the Northeast is next. But for home building, what matters really is the chart on the right, which is the South. The South being Southeast, excluding, let's call it Southeast Florida. And these are markets like Charlotte, as well as Atlanta, Dallas, Phoenix. So that's where the story is for new home building. So widely watched by investors is the S&P CoreLogic Case-Shiller Index. I would say when you look at this, we have clearly moved to new highs since the old peak in 2006. The rate of change is slowing down every month. So if we were to have this conversation looking at 2016 through 18, you would see for some of these markets, as I have here, actually it would be different. Let's start from the bottom, because the weakest markets, as you can see here, which are flat to down, Seattle, San Francisco, and LA, they were all up 12, 15% every year on pricing. So that tells me is the appetite for pricing is over, maybe, but they're not coming down. So then other markets have had velocity. Phoenix up 6.3%, as I mentioned, Charlotte up 4.5%, Tampa, and Las Vegas, which was the dire straits. There were more bankruptcies in Las Vegas than anywhere else in the country. Over the last 2 or 3 months, it was top 3, but it's slowing down. So everyone, we watch this, it's important. Slide 22 is let's talk about the home builder housing takeaways. Again, and just to kind of sort these out in terms of positive, neutral, or negative, the positive ones is the Sunbelt markets drive home building activity. The millennial shift and the builder shift is to entry-level community. The demand is there enormously. Someone getting out of paying $300 or $3,500 a month in Sunbelt markets, not in New York City, and saying I'm going to buy something with 2,000 square feet, which is a house. And the other positive is builder sentiment. The areas that we watch, of course, on changes, positive or negative, is housing starts and permits. That gives you a good lead for what's going to be in the next 6 months. We are coming into the winter months, which are slower. So no different than Boeing with backlog. Order and backlog value has been very good, and year-over-year comparisons for the home builders has been great. And average selling prices, it's interesting. They're beginning to come down, not for the reasons I mentioned about the housing market, because of the product mix shift from near luxury or move up to just going enormously into entry level. So what that means is builders have to build more, which is unit volume, because they're not getting it in the pricing per unit. Okay, let's take it to the next one. Slide 23 on U.S. housing starts. Generally healthy. And I was a little worried going back in August, September, because the year-over-year comps were not positive. We did get that in the October data. It tells me that this pivot to the entry-level homes is increasing the unit gains for U.S. housing starts, and that is likely to continue. Then for me, the question is, what is the impact on the revenue per home and the impact that it has on backlog and total home builder revenue? Moving on to slide 24. So this is really builder sentiment. This comes from the National Association of Home Builders. It's essentially their view of the markets. They do survey over 400 builder members of the NHHB when they do this every month. You know, in tongue-in-cheek, this is kind of like asking an investment banker how the M&A and underwriting pipeline is. It's always great, but I find this builder sentiment actually, it's a little bit more honest. And right now, it still is positive. What would be negative, if you look at the chart, the y-axis would be below 50, and you can see we're way above October HMI, even going into the winter, 71. All right, we got to talk about Sunbelt markets dominating home building, and you can see here is that this is really where all the home builders are, and if they're not, they are moving quickly into these markets because this is where demand is. When you look at single family units, so coming off the government census data, there's single family units are roughly 2/3 of total housing permits or starts, which shows you that this is a good indicator for the home builders themselves. And the South and West regions are 80% of housing permits in the most recent data. Let me talk next about investments. So pretty much you should have looked at the home builders back in November and December. Don't listen to any of the analysts. And then when the Fed began to cut rates in June, we then got to a point in summer where we went from a 5% 30-year fixed rate mortgage down to 3.6. That is the story driving price performance. Also here on the chart, consumer confidence continues to rise, and that's really good for the performance of these stocks. I would say on the rhythm of the numbers here, home builder stocks this year to date, are up 54%. Back in 2017, they were up 75%. In between in 18, they were down 33%. Folks, this is a hyper-cyclical group. The S&P 500 and consumer discretionary both up 21%. So my question to myself always is, if I come in even more aggressive into home builders, am I early or late for 2020? At least the fundamentals look good. This is a 3-year snapshot. I don't have any comments here, but essentially it's showing you that over the longer period, maybe with that comment about hyper-cyclical with builders, that you can see the best performing area is actually the consumer discretionary sector, not the home builders. All right, let's talk about a few featured companies. One, which was in the news yesterday, is Taylor Morrison Home. Ticker is TMHC. And as I go through 3 of these examples, there's 2 game plans that you can have. One is to grow with acquisition. The other is to grow and organic, or to grow organic totally. In the case of Taylor Morrison Home, they made another large acquisition yesterday to move up from the lower part of the top 10 to the number 5 builder, William Lyon Homes. That was a $2.4 billion deal plus debt. William Lyon is in Sunbelt markets. 85% of their closings in the last 12 months was entry level and first-time move-ups. You can look at these numbers. Generally, you want to see a chart on the left where the pipeline, the home deliveries, net order value, backlog is showing a cascading rise higher from right to left, which is 2017 to 2019. Then you say, well, how did they use capital, return of capital on the right? And you can see that even before yesterday's news on William Lyon, they have been acquisitive to grow. Now, here's the game that you play with investors and analysts. Essentially, if you're a management, you need to grow. Now, whether you grow with organic or acquisition, at the end of the day, every quarter, you want to show year-over-year growth in home building revenue and profitability. So when you look at the numbers, though, it's the community count. So there are builders like Taylor Morrison Home, KB Homes, et cetera, that have aggressively expanded total community count. Not everyone did this 9 months ago. And then when you begin to see of its impact on year-over-year comps, it's really positive in the market like that. Let's go to the next one. Toll Brothers is a great franchise. It's in near luxury. They have some move up. They have zero in entry level. And when we look at Toll Brothers, they're in a tough position, not only on product category, but on geography. Even today, about 30% of their backlog is California. So the ability for them to play the game I just described, their community counts really aren't going up that much. They extended their summer sales into October. I'll say that again. They extended their summer sales into October. And unlike Taylor Morrison, where we have a buy, we have a sell on Toll Brothers. And again, you look at the charts here, they're not cascading higher from right to left, 2017 to 19. They're very, very high quality company. I just feel that perhaps if we have a great economy over the next 2 years and people and consumers get even more aggressive on conspicuous consumption, Toll will do good again, but not on everything I'm presenting. Now we'll talk about Lennar. Lennar is a hold on the next slide. It's the largest U.S. home builder. Before Lennar, it was D.R. Horton, ticker is DHI. I have a hold, that's the Southwest Airlines of the building industry. D.R. Horton does everything organically, building starter homes, Texas, and the Sun Belt. Lennar has been all over and trying to do return of capital. It's a smart management. They purchased Cal Atlantic, so again, even if you go back 12 months ago, that acquisition gave them great year-over-year comps. It's funny how the analysts don't demand, as we have in real estate, same-store comparisons. So all of a sudden, you're in the frenzy of the earnings period, and you're looking at something up 35, 40%, and the stocks go up. But Lennar is a good company. We like it. They made some tactical acquisitions recently to build out in some distressed properties in the Gulf Coast of Southeast Florida and Palm Beach County. And with that, let's move to Varun to talk about the UK housing market, which I find fascinating. Varun, good morning.
Good morning. Thank you, Ken. And thank you to all our viewers who have taken the time today to attend this webinar. Before I proceed, some of you might find it odd that I use the term house builders as opposed to home builders. So a quick explanation on that. In the UK, the term house builders is more commonly used than home builders. So it's no different. It's the same sector, just to prevent any confusion. Okay, with that out of the way, in the next few slides, I'll compare macroeconomic drivers for the UK housing market, just like Ken did for the US. We'll look at consumer confidence, interest rates, household debt, income, and house prices. I'd focus some time on the interest rates as well as house prices, because I think those two are the key factors which drive this sector. And before I get into the detail on those economic indicators, on the next slide, I'll start with a quick note on the topic of Brexit, which you may have heard a lot of, or like myself, you're quite tired of hearing every other day. So what is Brexit? In June 2016, a referendum was held, and the outcome was a decision for the UK to leave the European Union. In the immediate aftermath, there was a substantial drop in investor and consumer confidence. That led to a fall in capital expenditure and weakness in the currency. So the reason all of this happened was there was no certainty on how the UK would leave the EU. So 3 years later, three prime ministers later, we have a general election and still no direction on what's happening with Brexit. And how does this all matter to housing? So the outcome of the election could be a substantial driver of house prices, mortgage rates, demand and supplies. The two parties fighting for this election, that is Labour on one side and Conservatives on the other, have differing views on corporate tax rate, social housing policies, subsidies to home buyers, and immigration. So keep this in mind, and we'll return to the impact of Brexit on specific drivers in this sector in slides further down. But for now, we'll go on to consumer confidence. Looking at this chart, the first thing that jumps out to me is it took the UK about as long as the US to recover from the bottom in 2008 up to 2015. In fact, it even improved to levels prior than where it was to the crisis. But that was short-lived until the Brexit referendum vote in June 2016, and it's been in a steady decline since. Now, what happened in the last 2 months? The last two squiggles on this chart, a tick up and a tick down, is quite important. As soon as the new Prime Minister was elected, the market had a lot of certainty on how things would proceed, and most importantly, it was ruled that a hard Brexit would not occur, which is leaving the European Union without any rules or regulations in place. And that ticked up consumer confidence. After general election was called, it ticked down again. So it tells us that this acts as a dampener to mood, and this all comes to a resolution by the end of this month. So we're expecting to see a huge boost for depressed sectors, and the house builders have improved a little bit in terms of valuation and prices in the last month, and the other general real estate sector in the UK has improved as well, be it retail or commercial. It's still far below international comparisons, but it does look set to improve. So with that, let's take a look at mortgage rates on the next slide. Now, before I get into the detail, the bigger picture here is mortgage rates are low and remain near all-time lows, both the fixed at 1.75% and the variable rate at 4.75%. Mortgage rates are low, and that's great for housing. For the benefit of my non-UK viewers, there are a few differences between the US and UK mortgage market. So in the US, longer duration fixed mortgages are popular, 20, 25, 30-year periods where you can fix the rate. In the UK, the length of most mortgages are similar, but the interest rate charged is not fixed for the entire period. Typically, the bank lends you money at a fixed rate for about 2 to 5 years, after which it moves to a variable rate. So, for example, if I took out a mortgage today, I might get a 2-year fixed period at the interest rate of 1.75%. And that's the orange line on the bottom of that chart. That lasts for the first 2 years. At the end of that, technically, my mortgage reverts to the higher rate, 4.75%. But it doesn't always work like that because the bank includes a clause where you can call them up and negotiate a better rate or even exit their service and go on to someone else with minimal fees. So now that we've seen how this works, let's move on to what we think could be the future of mortgage rates in the UK. So the Bank of England bank rate serves as the base rate over which mortgages are priced. The direction of the BOE rate influences the mortgage rate. In responses to the crisis of 2008, just like most other economies around the world, the BOE cut rates aggressively down to 0.25. Since then, it's marginally increased to 0.75%, and it's been held there as inflation has been stagnating. It's below the target rate of 2%, so the Bank of England had a meeting today. They've kept the interest rate still at 0.75%, and they've cited that given the lack of change in inflation, they're not going to move it at any immediate point. Now, the biggest risk to home prices would be a substantial increase in the rate. So as an investor, the key thing I want to know is what's the risk that this rate is going to rise so high that it's going to make housing unpopular? And the answer is there's probably not going to be very much that drives the probability of that occurring quite easily. There was one theory that in the event of a hard Brexit, that is an exit from the European Union without any negotiated settlements, there could be tariffs and the likes on goods and services that are imported, and that in turn would drive inflation, and that could drive interest rates up. But the Bank of England was quick to put that to rest. You can see the quote on the bottom of the page by Sir John Cunliffe, who's the Deputy Governor of the Bank of England, and he says any future increases in rates will be limited, and we should not expect to see a return to the levels of policy rates we saw before the crisis. So I think that's safe to say we don't expect an immediate rise. Any rise would be quite minimal, and it's probably in the interest of the BOE to keep it low as well. If you look around the European Union, most others are flat to zero and several are negative, including Germany. Okay, on that topic of debt, let's move on to the next slide and look at household debt and income. Now, the key takeaway here is the first chart, which is current household debt as a percentage of income is at about 125%. And that's much lower than the peak before the financial crisis at about 140%. This is important because it does signal that the average household is less likely to be distressed even in an event where house prices tumble. It's quite different to the previous cycle. And the chart on the right, the gray bars show that investments in new homes and major home improvements are increasing over and above pre-2008 levels. Again, this is not a bad thing. The UK faces a structural shortage in housing, so spending more on housing is not a negative by any means. I'll speak more about this imbalance of supply and demand a little later, but first we'll move on to house prices. So moving on to slide 39. The first thing that jumps out to me is that this chart is almost a mirror image or an inverse of what we saw the Bank of England do with interest rates. The blue line in this chart is the Nationwide Building Society Price Index. Nationwide is a building society, a mortgage lender in the UK, not dissimilar to a bank, but their primary focus on lending is traditionally been residential real estate. They have a long history, and this is the preferred measure of house price indices by many in the local economy. And I'll add a quick note. This might be of interest to some of our North American viewers. You'll find that several UK data points around economic metrics are quite often privately compiled, and that's just due to legacy issues. But for purposes of research and analysis, you'll find they serve the purpose quite well. And you can see the index over 11 years, it's risen here from 320 to 420. And that's quite a sharp uplift, but it's a bit deceiving when you look at it on the chart that way, because if you work out the compounded annual growth rate basis, it's about 2.5% per annum, and inflation was just shy of 2%. So yes, it's gone up, but it's not run away. Let's go to the next slide and consider what happened to the affordability of houses after the sharp increase in prices. So this is a graph of average house price divided by the average income for England in blue and London in orange. It tells me how many years of average income it takes to buy the average house. So it takes a person typically 8 years to pay off a house in England, and in London specifically, it's 13 times. And you can see it's dipped down a little bit in the most recent year in London. So this is an inverse of the image of decrease in mortgage rates. And all it's telling me is house prices are really sensitive to the BOE rate. And we'll go on to the next slide, and I think that draws out the difference between London and the rest of England quite clearly, because it is quite a tale of two markets. So the most expensive areas to buy a house are London and the southeast. Now, this is not driven by any macroeconomic factors like interest rates or debt levels. These are long-term secular trends in the UK economy. Traditionally, the UK economy was driven by manufacturing, cars, coal mines, textile, fisheries, anything that's from the old economy, if you will. That's changed. The economy is now more reliant on financial services, professional services, and non-manufacturing activities. And now most of these activities are based in and around London. So you can see that demand has been a fundamental shift, nothing to do with larger economic factors. The table on the right looks at the change in the affordability ratio over 1 in 15 years. So you can see that London has had the ratio increase by 54% over 15 years, but it's down in the last year. And we believe it being down in the last year has quite a lot to do with Brexit. It has been speculated that in the event of a hard Brexit event, many banks, trading houses, consultancies, law firms would leave London, and they'd move somewhere else in the European Union. And that could lead to people leaving London and moving out. But as we know, that risk has substantially been negated now, and the negative outlook in that brief period caused the decline over the last year. So that draws to an end the macroeconomic factors that I think are really important when looking at this sector in the UK. We'll move on to the next and have a look at the key trends and metrics specific to the sector itself. And we'll start with the UK housing market trends. So in this section, we'll look at current trends that might help us learn where we are in the cycle and what comes next, looking into 2020 and outwards. We'll look at the home ownership rate, the supply situation, the demand side of that equation, and lastly, we'll look at specific government incentives to help people buy homes. So let's start with the UK home ownership on the next slide. Okay, so home ownership in the UK peaked during the dot-com era of the late 90s, at the start of the millennium, and then started to slow, even through the financial crisis. So that slowdown from 2000 onwards correlated with an increase of interest rates that went on until 2008. So again, I'd really like to point out how important interest rates are to home ownership activity. And what stands out again is that home ownership finally starts to increase as BOE rates hit rock bottom at 0.25%. Now, we believe this trend is likely to continue if rates stay low, which we expect they will, supply increases, and existing incentives from the government to homeowners is maintained. So let's go on to the next slide and look at the supply side of this equation. So before we focus on the chart, the first bullet point on this page, the government is committed to delivering 300,000 homes a year by the mid-2020s. That's from the Ministry of Housing, Communities and Local Government from a report in 2018. Now, looking at the chart, current supply is around 222,000 per annum. The relevance of these two numbers is that 300,000 homes per annum is an estimate by the government of the minimum that is required to ease the current situation where there's a chronic undersupply. But there's quite a few reports that suggest that even 300,000 might be far too little, and the numbers could be much higher than that, going towards 500,000 a year. Compare that with what's being put out at the moment, 222,000 per year. So that's quite a difference that supply has to make up. Now, that number estimated indicates that there's a chronic undersupply situation. What leads to this is quite specific to a local level situation in the UK. Traditionally, the process requires that home builders get planning approval before they're able to put on a construction in a particular area. And that planning approval is from the local council. So they consider things like density of living, infrastructure, town planning, access to various resources. And this has been a very tedious process. It could traditionally take anywhere from a few months up to several years with lots of back and forth, but that's under resolution. So a takeaway from this is that supply has remained constrained, well below what is required to match demand. This could partly also explain why prices have increased so much. And the best way to combat a situation like this from a government perspective is to increase supply. And we're starting to see signs of that. The way planning permission is given out to buyers has changing, and landowners are able to get more planning permission and build more homes recently. So we'll take a look at the next slide on existing versus new home sales. Two trends jump out quite clearly. Looking at the blue chart, new homes sold are increasing as a percentage of total sales, and existing home sales are decreasing. Now, we believe a key driver of this is government incentives, and the most popular one is referred to as a Help to Buy scheme. I'll come back to this and talk about that scheme in particular, but bear in mind this trend that new homes being sold as a percentage of total homes sold is increasing substantially. And we'll look at housing permits and starts on the next slide, and that'll explain things a bit more clearly. So you may recall I talked about planning permission earlier. So you need planning permission to build a house. Now, the chart on the left shows a decline in the number of permits being issued. And intuitively, the first thing that tells you is less homes are being built, but that's not the complete picture. If you look at the chart on the right, once that's adjusted seasonably, there's actually been a gain of 16% of how many homes are being built. So you're left with this weird situation where the chart's telling you on the left that the number of permits being issued is going down, but the number of houses being built is increasing. And so the reason for that is most of the UK listed home builders have traditionally held large land banks. That's when they buy pieces of land, several thousands of plots covering many acres, and they hold them on balance sheet, hoping to build on them in the future. As these have started to become more valuable in recent times, as prices have gone up, home builders have started building on the existing land they own rather than buying more land. So while this economic indicator is important, viewed on its own, it could be misleading. So do bear that in mind if it's something you come back to. And on the topic of affordability, we'll go on to the next slide, which is affordable home ownership schemes. Now, before I go ahead, I'd like to state for any non-UK listeners, the word schemes here has no nefarious meaning. It simply means an organized plan, and in this case, it's a government plan to help first home buyers. Given the drop in affordability, the government introduced schemes to help first home buyers, especially targeting millennials and the like who are typically struggling with a large debt load from their student loan days, as well as fast rising house prices. So the Help to Buy scheme has been in place since 2013 and is eligible only on newly built houses. Now, recall a few charts earlier, we pointed out newly built homes as a proportion of total home sales are accelerating very quickly. Most of these were new homes that were built, and they're selling much faster than existing homes, which is a great thing for housing. We think this trend is going to continue. So in effect, the subsidy works in the context of the government provides a 20% loan, which is interest-free to a home buyer. So it allows an individual to buy a house with only a 5% deposit, as opposed to 15, 20, or whatever it is, because the government gives you another 20%. So in effect, you have a 25% deposit when you go to buy the house. And that 20% that the government provides funding with is interest-free for several years. It allows you to afford a larger house, in effect. And this increases in London. The government provides up to 40%. Of course, there are price caps in place, so you couldn't go out and just buy yourself a multi-million value mansion, but in London, it's about £600,000, which is in line with the average home in London. These schemes draw to an end from 2020 to 2023, and it'll be restricted and it'll be slowly run out. We don't think that is a substantial risk to home buyers because in all likelihood, any government that follows, regardless of whether they're conservative or Labour, whichever party they fall in, they are likely to maintain some incentives for first home buyers because this is a very topical issue, the lack of affordability and the inability of millennials to basically have the bare minimums of their existence. So that draws this segment on trends to an end. We looked at home ownership, increasing supply, sale of new homes, primarily driven by incentives. In the next section, I'll look at some of the house builder stocks that we cover at CFRA. We'll go on to the next slide on investments. Right, so when looking at the UK listed home builder sector, there are four major participants, and there's a tail of smaller ones, but the bulk of these four cover about 65% of the listed market, and they're Barratt, Persimmon, Taylor Wimpey, and the Berkeley Group. Now, the table on the top right should give you an indication for their size by market cap and enterprise value. I'd like to point out that while there's some difference, they are quite close to each other. They're all more or less equally sized in operations. Where they do differ is how they build across the country as well as their price points. So bear in mind that they're quite comparable in that context. Now, the second thing I'd like to point out in that first table is the debt to equity ratio. And I think this really differs from home builder stocks in the US as well as Australia and New Zealand and a few other markets I've seen that I can talk to. Debt to equity amongst UK home builders is really low. You can see here the largest is 10%, and I think that number goes up quite a bit more for a few others in other sectors that I've seen. Now, this debt to equity gearing ratio has been consistent since 2009. Leading up to 2009, most of them had much higher levels of debt, with the exception of the Berkeley Group, and of course they were punished for it during the crisis. Most of them lost substantial amounts of value if you measure it as their market cap. Some of them were down up to 95%, and since then they've recovered, and it seems they've learned their lesson, and since then none of them take on debt. And now the second table on this page looks at three key valuation metrics: price to tangible book value, price to earnings, and dividend yield. I've laid this out so viewers can get an idea of how the UK market typically values these stocks. Traditionally, it was based on tangible book value, and that's because the builders operated on a model where they purchased large amounts of land and held it on balance sheet. So the best way was to try and work out what that land was worth and then back out the share price from there. But increasingly, the market's shifted to valuing them on the price to earnings ratio, and lately it's been dividend yields as well. I mean, with dividend yields approaching double digits, that's so far ahead of most other instruments, and you don't see that very commonly outside of distressed businesses or highly levered businesses. I would say it's quite an anomaly in itself, makes it a very attractive proposition in this market. Now, let's look at some of these names in greater detail. I'll go on to the next one, which is Persimmon. Persimmon has one of the highest gross margins amongst the entire peer group, 32%. Management almost obsesses over this when they're buying land. It's an important metric to think about when analyzing house builders. So essentially, gross margin is the profit they get on each parcel of land. So when they're building up their land banks, if they can't quite clearly see a path to getting to 32% profit on each parcel of land, they're not going to buy it. And I think it's quite an important way to consider this business on the overall as well, because if they can sustain that, I can back out to what return on equity they can maintain in the long run, and that's how I prefer to analyze them. Now, the third bullet point on this page about average selling price of 234,000 in private and 117,000 in affordable segments. So one thing to point out is these two segments. So private is exactly what it sounds like. They build a house and they sell it to a private owner. Affordable is done in partnership with the government. It's not social housing, but it is a lower price point that's done so that generally a city does not exclude millennials, youngers, and other people. So in effect, the land is owned by a local area council, and the property developer, in this case Persimmon, works with them to build out a certain number of apartments, houses, whatever it is, and sell it on. Now, the reason that becomes important is because if the government mandates that they want to target 300,000 per houses per year, and right now they're 220,000, we think it is highly unlikely the government is able to start building houses of their own accord. They just do not have the funding to do that, and that hasn't been the business model since the 70s and the 80s. It is most likely that business will continue to flow through to these listed home builders. Now, the margins on that business is lower, and the volumes are lower, but it is steady and consistent. So you could see quite a long tailwind supporting these businesses once government policy is cleared up. And we'll move on to the next one, which is the Berkeley Group. The Berkeley Group is most exposed to the London market. The average selling price there is 748,000, right? Again, similar to Persimmon, they have gross margins of 31%, and they maintain similar discipline in buying land. It's also noteworthy that the Berkeley Group, who's one of the oldest in this sector, is quite an astute capital allocator. Historically, prior to the 2008 financial crisis, they substantially reduced debt well before the cycle peaked. And so I think it was just management's really good foresight. They managed to cut down debt, they reduced inventory, and they sat there ready with cash, ready to go. And the moment things were cheap, they started buying again. So this is something else I look for when considering this sector, where management has really good capability in deploying capital and how disciplined they are in chasing those returns and not overextending themselves just to get a year-on-year increase. And if you look at the chart on the left, cash, when you look at cash and cash equivalents building up, it's clear that it's built up over 17, 18, 19. I think it's quite likely that they're readying themselves to be able to buy a whole lot of land and repeat the good run they've had over the last 10 years. So it's one that definitely keep my eyes on. And it's noteworthy that all the builders have been doing this. They've been building up cash, and they've just been waiting to go as soon as once the political uncertainty and the like is resolved. So with that, I'll move on to Berkeley Developments. So Berkeley has a lower gross margin compared to the previous two. You can see their gross margins at 23%, and that gets reflected in the valuation. It trades at a price to tangible book value of 1.7, and compared to the others who trade at a much higher multiple. So the key driver of this business is going to be if they're able to improve this margin. If they're able to do that, and that would be from discipline in future land purchases, I would expect to see a valuation re-rating substantially to the upside. I hope that helps you get an understanding of the kind of metrics I'm looking for and what moves the prices of these businesses in the market. And another thing worth noting is that the average sales price is towards the higher end of the range. They're more exposed than others to movements in sentiment. And what I mean by that is, I think a good analogy would be if you considered airline travel. Typically, most people for shorter journeys would choose the cheapest available offering or are more likely to go to the much higher end luxury. The offerings that are in the middle price range don't offer too much value and are more likely to be ignored. Now, Persimmon, who we saw first, is the lowest average sales price across the UK, and we think that insulates them well. They're least likely to be hit in the event of a downturn, while Berkeley Group, who we saw second, is focused on London, more prime, higher end markets. They're less likely to be affected by the chop in consumer behavior in the middle of that price range. So with that, I'll go on to the last one, which is Taylor Wimpey. And again here, gross margin 26%, just like Barratt Development, it's reflected in the valuation. So you start to see quite a clear trend. If a house builder can't maintain a higher gross margin, they get rewarded with lower valuation. So drawing out what they're able to maintain in the future is a key driver here. And the average sales price, just like Barratt Development, is in the middle of the range. And I mentioned this earlier, that there's a trend amongst house builders to use their existing land banks versus buying new land. You can see that on the chart on the right. The order book's been increasing. The land held for development hasn't moved that much. So they're building, they're expecting more to be built, but they're not buying new land. And then the chart on the left, more capital is being returned primarily through dividends. So rather than buying land, they're returning capital. And we see that as quite a fundamental shift in their behavior in this last decade, to a lot more disciplined approach than it was in the years prior to that, where they were just run away with accumulating land. So that covers the four main stocks that we research at CFRA in London. Hopefully it gives you an idea of how we consider the sector from a valuation perspective. I'll hand over to Ken to summarize on what we've spoken about so far.
Okay, thanks, Varun. And we want to do rapid fire to get a few Q&A in. Obviously, we think the political climate, Brexit, presidential election are huge. Central banks play a role, and demographic trends are good. We got a lot of questions. So the first one on the U.S. market is, what is the outlook for mortgage interest rates in 2020? Actually, I went into the bowels of data for 30 years of monthly data on the impact of Fed funds rates, on mortgage rates, and on builder sentiment, and on home builder revenue. I think December, the Fed will pause. They will not cut rates again. In that 30 years, you had 10 periods of a rate rise and a rate cut. Bottom line, early 2020, mortgage rates will be at or just a little bit higher. And at the end of 2020, assuming that they will be higher. Next question, Varun, quickly, is given everything you've presented, would you buy a house in the UK today?
Absolutely. I did the numbers quite recently for myself, and I would save about £300 a month by buying a house on my mortgage payments rather than what I pay in rent. Interest rates are so low, it makes absolute sense as long as you're able to get the deposit together. And that's where the incentives from the government come in. Absolutely, yes, would buy a house.
Next question, U.S., is with the new limit on SALT, has that hurt housing resale prices? So in the U.S., SALT, by the way, is state and local tax deduction. We're talking about the 2017 U.S. Tax Reform Act. And I would say it's masked given the strength of the U.S. economy. So for markets in the Northeast, Mid-Atlantic, or California, we have not yet seen the true impact of SALT. But we are seeing, and I cover the office and residential REITs, that we're seeing an enormous migration out of these markets to Sunbelt cities, whether it be from California, corporations going to Denver, Salt Lake City, Austin, Dallas. It's interesting, when you look at housing rental communities and plans, they almost look the same in all these cities. And in the East Coast, including the president, is going to Florida, at least for his residency. So it's a big issue, but I think strong economy masks the situation. Another one for you, Varun, really relates to, you've noted well that there's a shortage of housing in the UK. Looking beyond Brexit, what would cause it to increase as far as supply?
Short answer, regulation. Long answer, planning permission. And that's being changed substantially. Parliament's discussing it as well. The process in place of how you apply, how long it takes, there are rigorous principles being kept on the bodies that approve it. And so that's due for a large amount of reform. We're not sure exactly when that will come through, but when it does, we expect to see a substantial increase in supply as well as the pace of construction.
Great. So to wrap up, first of all, I want to thank everyone for joining us on your valuable team. I want to thank CFRA, particularly the marketing team, for putting this together. And as you can see here, to get more information about our research and Market Scope Advisor, you can go to these website or locations, or if you prefer to call or email. Once again, thank you, and we look forward to your feedback and our ability to improve these presentations. Thank you.